Ever found yourself wondering how to read an income statement? Well, you're not alone. An income statement, also known as a profit and loss statement, is a financial document that details a company's revenues, expenses, and net income over a specific period. It's a critical tool for investors, business owners, and other stakeholders, providing a clear snapshot of a company's financial health. Knowing how to interpret it can be a game changer. So, if you're ready to unravel the mystery of income statements, stay tuned. Start at the top of the income statement with revenue. Revenue, in its basic form, is the total amount of money a company brings in from its business activities before any expenses are subtracted. It's like the heart pumping blood throughout an organism, vital for maintaining the financial health of a company. Companies can generate revenue in various ways depending on their business models. A retail business, for instance, generates revenue from the sale of goods, while a service company earns its revenue from providing services. There are also different types of revenue to consider. Operating revenue is the income from a company's primary business activities. Non-operating revenue, on the other hand, comes from secondary sources like investment income or sales of company assets. Gross revenue is the grand total, the sum of operating and non-operating revenues. Now that you understand the top line, let's dive further down the income statement. Moving down the income statement, you'll encounter the company's expenses. Now, expenses are the costs a company incurs in its effort to generate revenue. They are the flip side of the income coin, if you will. These costs can come in many forms, and they all have an impact on a company's bottom line. Firstly, we have operating expenses. These are the costs associated with running the day-to-day operations of a business. Think salaries, rent, utilities, the nuts and bolts of keeping a company running. Next, there's the cost of goods sold, or COGS. This is the cost directly associated with producing the goods or services a company sells. It includes things like raw materials and direct labor costs. Lastly, we have non-operating expenses. These are costs that aren't directly tied to a company's core operations. Things like interest payments on debt or losses from selling off assets fall into this category. Expenses play a crucial role in determining a company's net income, which brings us to our next section. At the bottom of the income statement, you'll find the net income. This is what's often referred to as the bottom line. So, what exactly is net income? Well, it's the result of a simple equation: revenue minus expenses. Picture it as a grand finale of a financial performance show. The revenue, the money your business has earned, takes center stage, but then the expenses, the costs required to earn that revenue, make their entrance. They duke it out, and what's left standing is your net income. Why does this matter? Because net income is a key indicator of a company's profitability. It's like a financial health checkup. If the net income is positive, it means the company is making more than it's spending. If it's negative, well, that's a red flag. Remember, it's not just about the final number, it's about the journey to get there. Net income is the final figure in the income statement, but understanding it requires knowledge of all the preceding components. You've now explored the major components of an income statement. Let's take a moment to recap and underscore the significance of each. First off, we delved into revenue, the lifeblood of any business. Remember, revenue isn't just about the numbers on the income statement. It tells a story of the company's ability to sell its products or services, reflecting market demand and the effectiveness of the company's sales strategies. Next, we navigated the world of expenses. These are the costs incurred to generate revenue, and they're just as crucial. They show us how efficiently a company uses its resources, and a sudden spike or drop can signal changes in the operational landscape. And then, we arrived at net income. This is the grand finale of the income statement, the bottom line telling us whether a company is making a profit or suffering a loss. It's the ultimate measure of a company's financial performance over a specific period, and it's what investors often look at first. But remember, these components don't exist in isolation. They interact in complex ways, and understanding these relationships provides a holistic view of a company's financial health. It's about looking beyond the numbers and deciphering the story they tell about the company's past, present, and potential future. And there you have it, a simple guide to understanding income statements. Remember, a keen eye on these figures can offer invaluable insights into a company's financial health.